Welcome back. This week we're diving into an investment report making a pretty bold claim.
A very bold claim.
It presents a bull case for Strive Inc., that's ASST, transitioning into a leveraged Bitcoin proxy, and it's projecting a potential stock price of $5 by 2026.
Right, and that's all based on Bitcoin hitting analyst targets of around $200,000.
Exactly. And I'll say the foundational work here is really good. The identification of ASST as this Bitcoin-tethered holding company is compelling. And that napkin math they use, it provides a really strong hook for the whole thesis.
I agree completely. That whole narrative, pivoting to become this baby MicroStrategy, it's very well captured. But for the sophisticated audience this is aimed at, we've identified three, I think, high-leverage opportunities to really refine the analytical rigor.
Okay, so let's jump right in at the core of it, the financial structure. Specifically, how this massive Bitcoin hoard is even being financed.
Well, that's our first point. The valuation model needs to rigorously integrate the financing mechanism, that perpetual preferred equity, to establish a stronger net asset value for the common shareholders.
The material makes a really strong case for treating ASS as a holding company. It states its 7,525 BTC stash will be worth an impressive $1.5 billion if Bitcoin hits that 200K target.
And that figure, that gross asset value, that's the hook.
It is.
That gross valuation is certainly attractive. But I wonder, have we really established the connection between that $1.5 billion and the actual common share valuation? The report mentions they're financing this using perpetual preferred equity, and it lists dilution as a risk, but the core math seems to only focus on that huge $1.5 billion asset value.
Wait, so it's like they're valuing a diamond ring without subtracting the huge loan you took out to buy it.
That is a perfect analogy. And with perpetual preferred equity, that loan, it never really goes away.
Right.
It's a senior claim on the assets that sits ahead of common shares. And for institutional investors, they scrutinize the capital stack. If you don't subtract that senior claim, the resulting $5 target just feels a bit, less substantiated on a true net asset value basis.
So the core problem is a structural one. The calculation is using the bulk case asset value, but it's ignoring the corresponding liability.
That's the key takeaway. So our suggestion is to really strengthen the analysis by moving beyond that gross valuation to calculate a true net asset value, or NAV, specifically for the common equity.
And that means estimating the senior claim of the preferred equity and deducting it before you apply any kind of premium.
Exactly. Because that premium the report is looking for, that 2 to 3x multiple that MicroStrategy gets, that's applied to the common equity NAV, not the gross assets.
I see. So if that NAV floor is artificially high, the whole premium multiple idea comes into question.
It does. You have to define that true NAV floor to legitimize the bull case leverage.
So how can the writer do that without, getting totally lost in the weeds and ruining that clean napkin math section?
I think one really effective way is to show a sensitivity analysis right there in the valuation section. Clarify if the current market cap of $917 million fully accounts for this liability, or
if the calculation should adjust that $1.5 billion down by the value of the preferred shares.
Yes. So, for example, you could say, let's estimate a $300 million liability from the preferreds. You deduct that before applying the 1x to 3x premium.
And that's super actionable. They could literally show our gross assets imply $5, but after factoring in the $300 million senior claim, our defensible NAV supports a range of maybe $4 to $450.
Exactly. It makes for a much more robust argument. It adds that necessary granularity, and it shows you've really considered the capital structure, which is key to justifying any kind of premium multiple.
Okay, so financial rigor means we have to factor in the cost of capital, but that's just one half of the equation, right? The other is the operational pivot itself. You can't talk about SSBT becoming a pure proxy without talking about what they actually bought, Semler Scientific.
And that leads directly to our second point. The analysis should clarify the operational strategy for the non-Bitcoin assets acquired through that Semler merger to really solidify the whole holding company model.
The report frames that acquisition of Semler, of SMLR, as critical for building a massive war chest of BTC assets. That's a very vivid, powerful image.
It is. It's great for the accumulation narrative. But could the evidence also support a more complex conclusion? By focusing only on Semler as a BTC accumulator, the report sort of overlooks the other parts of the business.
You mean the fact that it's a medical technology company?
Exactly. It's like buying a high-performance sports car just for the engine, but you also acquired this very specialized custom trailer that came attached to it. The focus is on the engine, sure, but the market has to factor in the drag from that trailer.
That's a great analogy.
And the report claims ASLGT is no longer analyzing a company based on PE ratios. But that claim gets a lot weaker if the company is still burdened by this legacy medical business that has nothing to do with the crypto thesis.
So the big question the analysis needs to answer is, what happens to the core medical business of Semler? If it just hangs around, it really complicates that clean holding company identity.
It does. So our suggestion is to bolster the holding company claim by explicitly addressing the fate of those legacy operations. Is the plan to dispose of the non-Bitcoin assets? Showing that strategic thinking would really demonstrate a consideration of the execution risk here.
It moves the analysis from just listing assets to providing a clear operational roadmap.
Right. And the material could suggest two clear paths. Path A could be a pure play scenario, where the analysis posits that those legacy medical assets will be divested, say within 12 months, to fund more BTC or pay down the preferred equity.
Okay, so that streamlines everything. What's the alternative path?
Path B would be an operational cash flow scenario. The report could clarify that Semler's existing medical revenue will be used as its perpetual, non-dilutive funding source for more Bitcoin.
Oh, so that turns the legacy business into a financing arm.
A critical one. And you could argue that predictable income stream actually reduces the risk profile. But either way, the report needs to choose a direction for those assets to get rid of that structural ambiguity.
And that kind of clarity would drastically reduce the perceived execution risk, which strengthens the whole thesis.
Absolutely. Ambiguity is the enemy of high valuation multiples.
Okay, I can see what you're going for here. The report is very transparent. It dedicates an entire section to risks, dilution, Bitcoin crash, execution risk. It's all laid out.
It is, but there's an opportunity there. To use that transparency not just as a disclaimer, but to actually strengthen the bullish outlook.
Right.
And that brings us to our third critique, which is really about structural integration. To maximize the robustness, the report should integrate the primary risk factors directly into the discussion of the bull case and the $5 price target, rather than, isolating them in a separate section.
I get the logic. Link risk to reward. But hold on, isn't there a risk that if you start mixing all that negative stuff into the napkin math, you immediately turn the reader off? Doesn't separating the risk section let the bull case land with maximum impact first?
That's a thoughtful objection, but separating them creates a kind of structural disconnect between the valuation and the operational reality. The way it is now, a reader can emotionally absorb that big $5 target without immediately internalizing the specific conditions you need to hit it. The analysis tells us ASST could hit $5, but it doesn't clearly show why the market would grant this premium, especially with all those risks listed later on.
So the weakness is that the premium is presented as almost a given rather than being conditional on them successfully managing the risks.
Precisely. So our suggestion is to enhance the persuasive power by framing those bull case targets as conditional probabilities tied directly to risk mitigation. Show the reader how the risks impact the multiple. We want them to understand that the $5 target is earned.
That's a great way to put it. It transforms the risk section from a boilerplate disclaimer into an actual operational roadmap.
That's the goal. Make the premium conditional. When presenting the $5 bull case, the analysis could explicitly state that achieving that 2x, 3x premium requires the market to have high confidence in, first, the smooth execution of the Semler merger.
And second, successful management of the dilution from the preferred financing.
Yes, the premium isn't a given. It's the reward for flawless execution.
Right.
And conversely, you can use the risk factors to justify the lower price targets. For example, the $2 base case, where Bitcoin only hits 100K, that could be framed as the valuation where the market assumes moderate execution risk.
Or that they failed to completely divest the legacy assets.
Exactly. It justifies a lower 1x or 1.5x multiple. By linking risk management directly to the valuation multiple, the bull case becomes this dynamic, conditional thesis built on performance.
That makes the whole analysis feel much more responsive to market realities. It goes from a static prediction to a powerful, evidence-based roadmap.
This analysis report has a fantastic core idea. That baby MicroStrategy narrative is compelling, and the math is eye-catching. The opportunities here aren't about rewriting the thesis, but really about solidifying the scaffolding that supports that bold $5 prediction.
Okay, so to sum up the opportunities for improvement, we have 3 high-level actionable suggestions. First, refine the net asset value calculation by rigorously accounting for that perpetual preferred equity financing structure.
Move beyond gross assets to calculate the true common equity floor.
Second, clarify the strategic role or the disposal plan for Sumler's legacy assets. The report needs to define if they're aiming for a pure-play divestiture model or that operational cash flow model.
Right, to solidify the thesis and justify that premium.
And finally, integrate the execution and dilution risks directly into the bull case valuation narrative. Make that $5 price target conditional on them successfully mitigating those specific risks.